For most of human history, money had a shadow. It existed in the physical world. You could weigh it, touch it, hide it, steal it, or lose it forever. Gold did not need belief. Silver did not need permission. Land did not need explanation. If trust disappeared, value still remained. That is what made early money powerful and limited. Kings could not simply create wealth. They had to extract it from the ground, tax it from people, or conquer it from others. Every option required effort, time, and consequence. Power moved slowly because money moved slowly. Scarcity kept ambition in check. But humans have always searched for shortcuts. As trade expanded, carrying metal became dangerous and inefficient. Goldsmiths and early banks offered storage. In return, they issued paper receipts, claims on real metal locked away in vaults. Those receipts were not money at first. They were proof, but something subtle happened. People stopped redeeming them. They traded the paper instead. That moment changed everything, because bankers realized a dangerous truth. Not everyone comes back for their gold at the same time. So they issued more paper than metal. This wasn't fraud. It was evil. Money quietly shifted from something that existed to something that was expected. Trust entered the system. At first, the risk was small. Then governments noticed. If banks could create money by lending promises, states could do it on a far larger scale. Wars were expensive. Empires were hungry. Gold was limiting, so governments partnered with banks. Central banks were born. Paper money became law. Gold still existed, but it was now behind layers of confidence, rules, and authority. This system worked until it didn't. World War I exposed the weakness. To fund destruction on an unprecedented scale, governments suspended gold convertibility. Money printing exploded after the war. Leaders promised to restore the old system. They couldn't. The damage was permanent. The Great Depression revealed the core flaw. When trust disappears, promises collapse instantly. Bank runs weren't about panic. They were about reality returning. People wanted their money back and discovered it wasn't there. Governments responded with control, deposit insurance, regulation, centralized authority. Money survived, but it changed forever, and the final break was still coming. 1971. The global financial system crossed a line that almost no one noticed. The United States closed the gold window. Foreign governments could no longer exchange dollars for gold. The final physical anchor was gone. From that moment on, global money became fiat. Currency backed not by substance, but officially, money was now backed by full faith and credit. But that phrase hides a deeper truth, because faith alone does not hold systems together. Power does. Without gold, money needed a new foundation, and that foundation was not trust. It was structure. First, taxation. Governments demand taxes in their own currency. This creates permanent demand. Even if you distrust money, you still need it to survive legally. Second, legal tender laws. Debts must be paid in official currency. Courts enforce this. Contracts depend on it. Money is embedded into the legal system itself. Third, monopoly on force. Behind every currency is enforcement. Laws are backed by authority. Institutions are protected. Borders are controlled. Trust is encouraged. Compliance is guaranteed. Fourth, and debt. Modern money is born as debt. When banks lend, money is created. When loans are repaid, money disappears. This ensures one thing. There is always more debt than money. Scarcity becomes permanent. Dependence becomes structural. Fifth, central banks. They no longer promise stability. They promise intervention. Markets believe that when things break, someone will step in. This expectation shapes behavior, risk, and pricing. Trust becomes institutional, not emotional. Money no longer represents value. It represents continuation. As long as tomorrow exists within the system, today's promises hold. This is not accidental. It is design. Once money lost its anchor, consequences followed naturally. Debt exploded. Governments learned they did not need to repay. They needed to refinance. Deficits stopped being emergencies and became policy tools. Inflation replaced taxation as the quiet transfer of wealth. Prices rose. Wages lagged. Assets inflated. Those closest to money creation benefited first. Those farthest paid later. Crises became features, not failures. Each crash justified more intervention. Each rescue increased dependence. Each solution planted the seeds of the next collapse. But the system did not reset. It hardened. Every generation tries to fix money. Some demand gold. Some demand transparency. Some demand digital trust. But the system resists reversal, because fiat money is not just currency, it is governance. It allows wars without immediate sacrifice, promises without present cost, power without accountability. No system that benefits from this gives it up willingly. So instead of reform, complexity increases. Rules multiply, responsibility diffuses, reality blurs. Trust does not disappear, it is engineered. So what really backs money after trust is all that remains. Not gold, not productivity, not morality. Money today is backed by state power, legal enforcement, permanent death-controlled inflation, and the assumption that the system will continue longer than any individual life. Money is not fake. It is fragile. It works only because most people never try to exit at the same time. History shows that systems do not collapse when people criticize them. They collapse when belief and enforcement separate. When laws exist without legitimacy. When promises exist without patience. When continuation is no longer assumed. 3 takeaways. 1. Money is a system, not an object. Understanding money means understanding power, incentives, and control. 2. Debt is the foundation, not the flaw. The system is designed to expand forever. Collapse happens when expansion stops. 3. Trust is manufactured, not earned. Confidence is maintained structurally, not morally. We have not reached the breaking moment, but every cycle believes it won't. If you want to understand money not as numbers, but as history, power, and consequence, because the most dangerous financial truths are not hidden. They are normalized. And one day, normalization ends.